Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending February 10th, 2023. Thank you all for tuning in and subscribing to this channel as well as our podcast, InvestTalk. Now, I'm Justin Klein and CEO of KP Financial, and today I'm going to kick off with my favorite dashboard, which is this good Morningstar overview of what's happening. Now, the most interesting part for me is that if you go back about a week ago or 2 weeks ago, the yield curve was inverted starting at about 6 months. Now it's not inverting till after a year, right? It's basically flat from 6 months to a year, which basically is saying, hey, the Fed's going to pause within 6 months, but they're not going to cut within a year. Before it was cut within a year, and that's definitely something you have to think about when you're looking at the charts, which we'll get into, of why the dollar's gone up, why interest rates have gone up, why the market's pulling back, etc. Okay. Now, we still, over the last month, you still have growth outperforming. We saw that big bounce, but it's starting to shift. And you can see this, if I just go this to one day, this was Friday. So you see how big of a difference in the performance of growth versus value. So while growth had its nice little kick up since the beginning of the year, that looks to be waning, and it should be no surprise that coincides with interest rates going up, dollar being a little bit stronger, etc. Now, for the week, you see the VTI that was down decently for the week, so you saw that pullback overall. But you see over the net, let's go to the one-day return. You can see the defensives, energy did well on Friday, industrials. And what was weak? Technology, communication services, consumer cyclicals, a lot of the things that were weak last year. And so keep an eye on that think about that once we get into the charts. Now, here is the CME Fed Watch. So 90% chance we'll get a 25 basis point hike in March, and then, which is obviously way up from a month ago, right? And then you have May, that's a 74% chance of another 25 basis point hike, which is way up from a month ago. See this 50 to 525 range? Well, that was only 31% chance we'd get there a month ago, 74% chance now. So once again, the market pricing in a higher probability of higher rates. Then you go all the way out to June, which, a month ago, it was basically a pause, right? It was basically saying, the Fed's definitely going to pause by June. Now there's actually a 38% chance they'll continue going in the month of June on another 25 basis points. And July, potentially a 7% chance they'll go again. So that's what you're saying. I don't really believe this. I don't believe the Fed's going to go this high. I'll look at economic data in a second, but the market's pricing that in. And obviously, when the market prices in, that means the market's moving. And so definitely something to consider, because if the market's not really moving dramatically on that news, then that's kind of telling you something, okay? Now let's dig into the economic numbers over the past couple of weeks. We have the ISM manufacturing new orders, 42.5. You only get these levels in a recession. If we go zoom out here, let's go to interactive chart. And then I'm going to overlay recessions. Okay. Here we go. So you can see 42.5. Do we ever get there in a non-recession area? 43.5 in June of 95. Didn't have a recession. What was it back here? 46, 45, yeah, it never got down to 42. 45.10 is as low as it got there. So you can see that outside, here's one. What's this? 35.8. This is 1952. Yeah, you're talking World War II era. So you basically don't get this low of reading without a recession. However, remember, manufacturing over the years, further back you go, is a higher percentage of the overall economy, right? And then you have right now it's more of the services, okay? And so you have manufacturing PMI that came in at 47.4, also a deceleration. You have the prices paid index that did tick up a bit. Now you would say, oh, this means inflation's reaccelerating. All this is saying it's not shrinking. Remember, under 50 means it's shrinking. Okay, so prices continue to come down. Okay, and then manufacturing employment index, that was pretty much flat. So the economy, or the employment market, is pretty much at neutral, right? Manufacturing is at 50.6, which we'll get over to. Services here. Here's new orders. That ticked up higher, so that was strong. PMI above 55, so growing. Services employment 50, right? So flat. So the employment side of the market is neutral across the services and manufacturing. And manufacturing is obviously in a contractionary mode. Services, though, remain relatively robust. Like I said, 55.2 on the overall PMI index, and new orders 60.4, the highest level really since September. Okay. And then you had the prices paid index, that was 67.8. So another deceleration. So that's where you continue to see this is growth in prices. And so this is where the inflationary pressures are coming from. Now the recession probability is now up to 57% going out to January of next year. And then the initial jobless claims, you just saw the first tick up last week. And remember that a lot of the job losses are coming from sectors that are fairly highly paid. And so they get severance. And so you can't file for unemployment until your severance is up. So I expect that to be a lagging indicator more than typical. Now let's get to the markets as a whole. We have the S&P pulling back here, but just to the 20-day moving average, right? This is technically, there's nothing to worry about. You're in oversold conditions on the R squared, or sorry, Williams percent R. MACD is rolled, it's crossed, but it's still above the zero line, so not a whole lot to worry about quite yet there. The NYSE, obviously a broader index. That one, same kind of thing. It doesn't really, it's broken the 20-day, but not the 50-day, right? The 50-day is really the main one, right? Pulled back here to the 50-day, held it for a few weeks, and accelerated to the upside. That's the one I'm watching on the NYSE. But I want to get to this, which is the IWF to the Von V, which is growth to value, right? You saw this rally from the beginning of the year, growth outperforming. Well, Friday was the first kind of shot across the bow that, hey, maybe that rally is over. And you saw a lot of weakness in the tech sector. You can see the Qs here, just having really a rough week. And if you just go to the Q, well, I don't need to do all that. But let's go to the VIX. The VIX is higher, but it's not breaking out. It tried to break this 50-day moving average. I was saying, that was a level that I wanted to, will be an important level to see if it holds. So far, it has held. So while it's easy to get bearish after this recent pullback, I wouldn't get too bearish quite yet. Here's the Vixen. Now this is the one where I'd say, okay, this is starting to break above the 50-day moving average. It never really tested that once. So this is the first major indication that we're going to get more of a bigger tech pullback, because this is the NASDAQ. But I want to get to the credit markets, because this is the one where the first kind of clear shot that, hey, maybe we're going to get into choppier territory. And this is the SHYG to the SHY. So this is high yield, short-term high yield to short-term treasuries. So if this is rolling over, credit spreads are widening out. And so this has broken that 50-day moving average, and something you want to keep an eye on. Now, it's still making a series of higher highs and higher lows really since the summer. Right? This is one of those reasons why I didn't think that the market was going to break down in October, despite the very negative sentiment, because you didn't get credit spreads really widening out. So, I'll be watching this, really the 100-day moving average, because I try to break that, for a couple days and then reversed a couple days later. So if it breaks that and stays below that for an extended period of time, then I would start to get a bit more worried. But something to keep an eye on. The MOVE index, that one is ticking up a bit as well. So, it's been positive that this has pulled back, right? This has been pulling back since October, and the market's rallied. If this breaks above the 50, another kind of evidence that the risk-off sentiment is coming back. Okay, and right now, so far this year, it's been in relatively risk-on. Okay, now the 10-year that has ticked up a bit, and so that's one issue, right? And this is the market pricing in a more hawkish Fed, and that certainly would bring in a more tighter liquidity dynamics, just say that. Okay, the dollar also getting a bit of a rally, but not really breaking out. And so what you're seeing here is some evidence, but not a lot of evidence that risk on is here. You always have pullbacks within risk on environments, right? Bullish environments. And so far, this has been pretty run of the mill. But you have to call the balls and strikes. And so, the credit spread, something I'm watching, move index, the dollar, to see if this gets more traction to the upside. So definitely watching that. The GDX that has pulled back pretty strongly. This is kind of a leading indicator to what the market was going to do. You saw that weakness a couple weeks ago. Gold also getting a bit of a pullback, but not breaking that 50-day moving average. So not getting too worried and too worked up about that. Energy getting a resurgence here. I've said it was relatively weak to start the year compared to the broad indexes and the tech industry, growth stocks, but the technicals are much, much better, right? So here's XLE, and then here's ARK. Right? ARK had a nice rally, but look at the technicals. They still remain in a major downtrend. Okay, so don't get too worked up about the recent rally in growth. You're always going to get these counter trend rallies. And longer term, you can see the sectors that are doing well. Those technicals look much, much better. There's IYM right above the 50-day moving average. Look at XLI, the industrials, above the 50-day moving average. So over the medium term, you easily say that this is an opportunity to reallocate away from the growth side of the market and into the value side, which is starting to gain traction once again. Here's the transportation index. Transportation also looking relatively strong. And then I want to look at this. Actually, I haven't looked at this in a couple days. What did it do on Friday? Rally. Okay. So that's another indicator that maybe the risk off sentiment isn't going to turn into a fervor, right? October was a fervor, right? Everyone was bearish. And the fact that the investment banks are hanging in there compared to the commercial banks tells you a lot. Here's XLY to the XLP. Yeah, that got a little rollover. This is kind of the growth versus value trade as well. So overall, market's pulling back. A lot of things to keep an eye on, but not enough evidence to say this rally from October is over. You can easily see the Fed come out and not be as hawkish as they've been over the past week or two, especially with economic data that's coming in next week. So keep an eye on all that. And that's where we're at. Overall, more neutral to bullish short term. And you continue to see that rotation longer term out of growth and into value. Thank you all for tuning in. I hope you have a wonderful weekend. Reminder, the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a great weekend.